At the end of the day, actions speak louder, and it can only make sense if it's out of a purpose, out of a very strong value system, which of course has to be around respect, which has to be around embracing diversity, which has to be about trying to learn always from others, and it has to be about a culture of excellence. As the motto says, if we fail to prepare, we are preparing to fail. And that's very, very important always to prepare well, to have a plan, and to be able to be resilient around that plan, which is to adapt.
Hello, and welcome to Season 2 of Conversations on Climate, the podcast series which has been developed in partnership with the London Business School's Alumni Energy Club, which I've been leading a series of conversations with experts from around the world exploring the biggest challenge of our time, climate change. Today we're dealing with a critically important part of the energy transition. While we all rightly celebrate the rapid deployment of solar panels and electric vehicles, we don't always think about the materials demands of that revolution. Are we going to be able to supply the natural resources needed for the energy transition? What are the market forces driving the impending supply crunch? How much of a role does China really play in the supply chain? How can the metals and mining sector clean up its own act on carbon and governance? Exploring these areas today is Abel Martins Alexandre, Managing Director and Head of Energy, Infrastructure and Industrials at Lloyds Bank Group, and formerly Group Treasurer at Rio Tinto. With close to 30 years of experience in the sector and an MBA from LBS, Abel is a sharp, thoughtful speaker with a depth of experience that's second to none. A passionate believer in the need for the energy transition, this conversation on what must be done to get there is one you won't want to miss.
Around 80% of people who listen to this podcast haven't hit the follow button. If I could ask you for a small favour, if you do enjoy our conversations, please do hit that follow button on your app. It would help us in the show more than I could possibly say. Thank you, and enjoy the conversation.
First, thank you so much for joining us here. Out here in the wonderful London Business School for hosting us to have this really, really super conversation.
No, that's great to be here. It's great to be back at London Business School. Both you and I are alumni here. That's the first time in this beautiful building.
But first, I could talk a little bit about yourself. You've had a really interesting career, kind of spanning commodities, industrials, finance, currently MD at Lloyds Bank Group. Could you tell us a little bit about your path up until this point?
Yeah, sure. I mean, I'm Portuguese by background, grew up in France, went for a first job in Brazil, working for a bank at the time, took me to South Africa, then to Paris, covering Russia and what we used to call at the time CIS countries, so Central Asia. From there, I moved to a mining company, to Rio Tinto, where I spent 15 years, wonderful experience. And now, almost 2 years ago, I switched back to banking, where now I am Managing Director and Head of Infrastructure, Energy, Industrials at Lloyds Bank Group. So I would say I'm not the best advisor when it comes to career. My own choices were certainly led by personal circumstances and instinct, and I'm very grateful for the career I've had.
We had Tara Schmitz, your wonderful colleague, on last year.
She's wonderful.
She is wonderful, and we spent a lot of time talking about the intricacies of ESG in banking. But maybe if you could just give us kind of an update, what have been the big developments? There have been a few big developments in the whole ESG and banking space.
Yeah, that's right. It's been an incredibly busy year. I mean, it's been a year of mixed feelings. Really, we have progressed a lot in a number of fronts. Well, first, the investments in renewables have now outstripped investments in oil and gas, which is really pleasing, really good. I think the cost. The levelized cost of energy, wind and solar, is now lower than it is for other energy sources in most instances, in most countries. So that's really good. There is an increased impetus for financial institutions and organizations at large to implement more credible transition plans. And the dialogues are very much about having an impact beyond what was seen before as a compliance exercise, which some may have thought ESG was all about, but I think it's much more entrenched now. And we have to be very pleased with the fact that partners at large, institutions, corporates, policymakers are leaning in much more into how we solve this very complex problem. On the other hand, it's also been a very difficult year. ESG has become relatively politicized. in the US, potentially also in the UK now, in other parts of the world. And that's very unfortunate, because I think the last thing we need is politics getting involved in what needs to be an accelerated pace of change for the transition. That's number one. Number two, of course, geopolitical tensions are increasing supply chain disruptions. And that's really difficult, because it creates bottlenecks, which are already relatively high. It also probably increases what I think is an inflationary environment for energy transition for longer than we believe it might be. There is one positive I need to highlight, of course, which I think is structurally important for all of us and for policymakers to think about, is what has happened in the US, with the significant push towards much more investments on the back of course, the Inflation Reduction Act and another set of incentive measures.
I think we're very much focusing in on the E of the ESG, and that's in this conversation. One of the main issues about the whole ESG area, and particularly there's been a lot of attention drawn on it, particularly this year, is how you measure. How can you compare and make sure that two companies are doing similar things? How do you measure the non-carbon element of ESG? Where do you see that evolving now?
Yes, I think the entire data piece, measurement, assessment of emissions and other aspects of ESG is complex. There's no standardization. One should be pleased with the standards that have been issued by the international sustainability standard boards, but clearly it's not enough for it to be fully embedded. We need more consistency and more common standards across the board. But at the same time, we should not be blinded by the fact that that's only one part of the problem. We'd rather measure, of course, as accurately as possible than not. And that's where a number of stakeholders, including financial institutions, are trying to support getting better data, more comprehensive data, and comparing the emissions, for example, from one business to another, and draw the right questions. Data measurement is never the answer in itself. It prompts insights, and it prompts conversation, and it prompts action. We should not be blinded by data or by a model. Data is not necessarily evidence. What's really necessary, I think, is to get into measuring much more, and have the right conversations about the pathway towards decarbonizing or transitioning away from fossil fuels or the footprint that any given business could have today. So that's only one part of the equation, really. I think the other part is how do we move away from believing that targets are a strategy? Targets in themselves are never a strategy for ESG or for any other matter. So I think that's where the credible transition plans come into place. That's where the transition plan task force set up by the UK government and the FCA comes into play. We really need to make sure that we have the right ambition, we have the right actions that support them with the right plan, but also the right accountability model, the right governance. And as credible transition plans are implemented, I think we will see more progress towards transition. But it's a journey, clearly. There's much more work to do to that effect.
Okay. There's a lot of kind of fundamental paradoxes within the metals and mining, energy transition. So, like, for example, the energy transition is both urgent, but we are not doing enough about it. It's a great opportunity, financial opportunity, but it's underinvested. You have written quite a lot on the possibility that an energy transition might actually be kind of net value destructive.
Yes.
And you've also kind of made comments about it being, about us requiring a warlike setting, but broadening it out from beyond just a warlike setting for what we need to do, but also, with the potential destruction, of assets and whatever else. Would you like to talk a little about your thinking there?
Well, listen, I think we live in, as I mentioned earlier on, in a world where ESG has become more and more politicized, and that's really unhelpful. We often, all of us, have conversations where we try to strike the balance between between the dogmatists and the dissidents, no? The doomists and the deniers. Because at the end of the day, it's not about being optimistic or pessimistic, it's about being determined to change. And no, the next best alternative doesn't look good. So that's one aspect to it. The other aspect, I think we are often lacking a fundamental strategic conversation about the topic, be it oil and gas, be it critical minerals and the role of fundamental role that mining and metals play, be it the way we consume, etc. I think as we look at the fundamentals of the transition, we need to understand the unconvenient truth that it's very costly. It will be net value destructive. Now, the alternatives are even more net value destructive. In other words, the cost of transitioning away from an economy, an energy system as it stands today, to a different one cannot be but quite significant. Because we are replacing installed capital, which has been installed for many, many decades, by a new set of capital. A set of capital that has been depreciated to a large extent with a new set of capital that has not been depreciated. And we are doing that with a demand that is not changing fast enough. And we are doing that in a context where monetary policy has become more restrictive. There's also not enough investments that are going into this. So where is the money going to come from? It has to come from somewhere, and at the macroeconomic level, it's fundamentally through increased savings, which themselves have to happen either through increased interest rates or through a tax burden. And that is value destructive over the short to medium term, and it also creates a decrease in purchasing power for most people. So, of course, there's a significant opportunity for businesses and for stakeholders at large. And we have no choice but to lean into this because the alternatives are far, far more value destroying. But I don't think there's a sense of urgency, number one, in really understanding the magnitude of the issue, the magnitude of the cost of it, and number two, in actually ensuring that we understand that the next best alternatives are even more value destructive. Clearly, I'm a finance person, so looking at it in terms of NPV makes you think that actually it's not that bad. But we get to two fundamental points. Number one, do we have the incentive prices today, in particular in metals, captured so that investment is fundamentally increased? And number two, are we pricing the risk effectively? And the answer to both questions is no. And that's where I think the conundrum happens. The last point I would say, which is also an inconvenient truth that we know about, but we probably don't see reflected enough in policy making, is demand. How do we change demand so that we, you and I and everyone else, becomes more aware of what we consume, the price of what we consume, the impact of what we consume in terms of climate change, so that the behaviors change more quickly. The market response is very clear. No, the supply is still responding to the demand. So we need to stay into the demand much more actively, and policymakers have to lean into it much actively, I think.
So moving on slightly now to the core of the conversation, kind of metals and mining. We have been very quick to celebrate, the amount of EVs on the roads, the amount of solar panels that are going up, a very large amount of large wind turbines being put offshore. There's some kind of significant steps forwards happening in the renewable energy market, but we're not really focusing in on the components of those particular technologies. One of your kind of favorite hashtags is no metals, no transition.
That's right.
which gets attached to a lot of what you write. Would you like to kind of explain that? Why are metals and mining so important to the energy transition?
Yeah. Well, first of all, I'm not the author of that hashtag. I borrowed it from Julian Kettle at Wood Mackenzie, I must say, which I think is fundamentally true, right? No metals, no transition is fundamentally true, and we need to create a heightened sense of urgency in regards to the awareness the bottleneck we have there. I mean, we will need twice as much copper by 2030 than what we are producing today. We'll need 4 times as much nickel. We'll need, I think it's 2 or 3 times as much cobalt. We'll need a significantly increased supply of uranium also for nuclear power, if nuclear power is a solution chosen by some countries. And of course we need more lithium, but and we need more graphite, we need more rare earth elements. And by the way, we need also twice, if not 3 times as much steel. Steel made out of iron ore and today carbon, and because we don't, and by the way, we don't have a green steel technology fully proven. There's only one green steel mill, I think, in Sweden nowadays, and many companies are looking at it. So we need significantly more supply of metals and critical minerals so that we have a higher volume of batteries, of course. That's what catches the attention. But so that also windmills are built, so that we rebuild buildings in an emissions efficient way, but also so that we electrify the grid. All of it requires significant amounts of copper. Aluminum is also absolutely required, and there's more green aluminum now than there was, but we need more aluminum coming out of bauxite, the mining of bauxite and the refining of alumina. And the investments are not flowing through, and there are a number of reasons to that effect. Number one, I think the large mining companies have been burnt 10 years ago or so by a significant splash of capital and a number of ill-fated decisions, out of which they had to do a number of write-backs and create much more discipline promoted by the shareholders in regards to capital allocation framework. And we will have seen now the mining companies actually increasing the investments towards transition, but still in amounts that are much lower than what they were 10 years ago. As a paradox, and depending on the mining company, but no, the top 3 are investing between $7 and $12 billion per year. And 10 years ago, some were investing at capex programs of $18 to $20 billion a year. As a paradox, where incentive prices were actually better at the time than they are now also. So that's interesting. I think the shareholders of the large mining companies have really imposed a certain discipline on these companies, which I think is the right thing to do. But it also says that the incentive prices are not sufficient. Number one. Number two, projects are getting even more so complex. Grades are depleting across the world, across the main resources, and we're talking about very, very large resources, very large projects, which not many companies are capable of doing. Actually, only a very handful. We need the equivalent of probably two Oyu Tolgoi mines per year to meet the demand for copper in 2030. And these projects are extremely complex. Only the best mining companies, just a handful of them, can develop these projects. You need more people, you need more project managers, you need more geologists, you need more rock engineers, and they come in short supply. Of course, you need more people also who can partner with governments, and you need the right policy setup. You need to partner with these governments, and these are conversations that take a very, very long time. The overground issues are as important as the underground issues, and rightly so, because at the end of the day, mining companies are hosted by communities, and they need to have a net impact for the communities also. Water is a fundamental issue in many countries, and water is scarce. And how do you price it adequately? So I think the issues are very, very tangible, and will become more tangible as we see it, for example, for offshore wind, where the bottlenecks are now really evident, and for EV, for electric vehicles and the batteries, where bottlenecks are being seen even more than they used to. So for all the discussions around chips and the scarcity of chips, which is true, there's a broader conversation about the scarcity of metals, which I think is going to hit all of us, I suppose, in a more meaningful way in the next couple of years, if not before.
Yeah, that's a brilliant overview of the whole area. Before we kind of dig down into a few little kind of more the specifics on each of those kind of big broad brush headlines you were outlining there, is there any just out of curiosity, any particular elements or metal that is underreported? We all know, we hear about copper and cobalt and lithium, but is there anything else that's from your experience to say, no, this is something we need to be talking more about because this is something that's really going to cause a problem?
Yeah, I think the US Department of Energy, I think, has listed, if I'm not mistaken, around 20 critical minerals. European Union has listed 14 critical minerals. The UK has a list of around 12 critical minerals, if I'm not mistaken again. So there's a list there, but they are not all equal in, if I can put it this way. For copper, aluminum, nickel, steel, which is a transformed product already, are all absolutely critical, and they have this particularity of being coming from very, very large resources. And they are relatively large markets. You have, and in particular, the base metals are traded, they are fungible markets, so you have pricing discovery that's much easier than other products that are also critical, other metals, cobalt, very critical. Then you, of course, have the rare earths elements, which are nothing but rare, by the way. They're just quite complex to extract, and they so happen to be often in the wrong locations from a geopolitical point of view. They are equally important, but they are relatively smaller markets. Everyone talks about lithium, very, very interesting market. The jury is still out as what is the right technology for batteries, most of them containing lithium. But the jury is still out also as per whether we get the price forecasts right, because looking at the cost curve, I think it's a quite steep cost curve, which means volatility in simplified terms. So they are important, critical, but relatively smaller markets. So that's one aspect of it. But the other aspect of it is actually the processing and manufacturing of minerals, which we often forget, because of course we think about critical minerals as being commodities. Yes, to some extent they are. But they go through a significant value chain, a significant complex value chain, and the processing and manufacturing of these critical minerals and metals into products that then electrify the grid, go into the batteries, go into the houses, etc. Is of critical importance. So bottlenecks may happen there too. We all know that rare earth elements, lithium also, have a processing and manufacturing footprint that is very, very concentrated in China, and also for the batteries in a handful of companies, actually 4 companies only. That creates situations of bottleneck. Most of the processing of nickel happens in China too. So we need to understand the value chain much better to reassess where the bottlenecks are and how we create resilience around the supply of these metals.
Right. Yeah. Okay. So you've done a great job in outlining the increase in demands and why that happens. Can dig a little bit more into this whole supply side area of it. So the first question is, the obvious question is, in a world where we've got an assumption of perpetual growth, and a planet that has finite resources, at what point do we start to run out? Like we've seen ore grades falling. At what point do we start to run out? And is that something we need to worry about short, medium, or even long term?
So I'm not expert enough on the topic to have a good answer, I suppose. We've been running out of oil and gas for many, many decades. We've been running out of food. In the past we used to run out of food also. We run out of many natural resources for long, and the life of a natural resource can be 10 years or 15 years for many decades. So I think we really have to put things into perspective. I think the question is, where can we access in the quickest way, in the cheapest way, and in the most sustainable way, the resources that we need, that the world needs. And of course, we would be concerned, I suppose, as a society by, for example, deep sea mining, which is best left to the large mining companies that are really serious and are really extremely well intended and have strong, stringent controls in place. But even that, I'm not an expert enough to actually qualify as per whether that's the right route to go. But the fact that we are looking at deep sea mining epitomizes the fact that we have very expensive resources out there, either because they are expensive to extract, or because the grades are relatively weak, or because they're in locations that are not palatable from an environmental point of view, from a political point of view, from a reputation point of view. I think there's something to be said about technology, of course, and recycling. Technology keeps on improving. I mean, the way we extract copper today is very different than it used to be. And there are not only the large mining companies, but a number of tech companies are looking at better ways of extracting and recovering metals out of the same ore. There's lots of technologies trying to recover even more metal out of tailings, which are in a sense the waste out of the mining process. And of course, recycling of metal. There is much more that can be done. I think these two avenues, and there will be others, but technology improvements as well as increased recovery and recycling are fundamental, and much more investment is going into this. And there are better ways of looking at increasing the production than ways that are probably much less sustainable.
Yeah, no, it's a very appealing idea. The idea that, which has been floated around the European Union quite a lot, that the electric vehicles that are driving around the roads are little mines with lots of materials that are needed for the next electric vehicle.
That's right.
Do you what's your feel of how that's going to progress? Is it like, how much can you take in from an existing battery and take it into the next one, and how close are we to be able to make that circular?
Well, I think all the automotive industry is looking into that. I think that given the fact that the value of an electric vehicle stems apart from the marketing premium and the increased size of the vehicles, which is unfortunate, stems from the battery. The weight comes from the battery, and the battery, as you said, includes a great deal of metals, as do our cell phones, as do all the electronics equipments that today go to waste. And there are a number of companies out there that are trying to make a business model out of it. So I think that's very comforting. And that entire circularity that a number of businesses are looking at, from mining companies to automotive to manufacturing. I think some companies do it very well, and some are my clients. So I think it's really important, and they do it because they also not only do they see the value, but also, of course, it's part of defining emissions. At the end of the day. No, that's why the supply chain matters. Measuring the emissions across the supply chain matter a great deal, and that's where partnerships alongside the value chain matter a lot. Is how to create that circularity. So we are making lots of progress. How much can be recovered today from a battery? Quite a lot. How much is being recovered economically? In other words, with a proven supply chains, I'm not quite sure, but we are not there where we should be. That's clear. But I think I'm pretty optimistic if I look at what a number of companies are doing on this.
Okay, yeah. So taking a little step back to the miners and the business models that the big companies that you mentioned are running. You mentioned that they were driven by a super cycle, which kind of a boom and bust super cycle that happened a decade or so ago, driven largely by the demand large demand in China, and then kind of fiscal conservatism that came afterwards, where it's been more about preservation of capital rather than large expenditures. You also mentioned that it takes a very particular set of skills to be able to put together one of these super projects, and probably any of these large businesses could probably only do one at a time. Like it's not that you've only got 4, but they can be doing 10 each. You're okay. No, I can probably only be doing one at a time because they're so complex. This seems like a pretty difficult nut to crack, where you've got a series of businesses that are being fiscally responsible in some sense by doing share buybacks, doing dividends, and underinvesting in markets, as we're entering another super cycle. Like it doesn't seem to be, it doesn't seem to fit. Like if your business is going into a cycle where there's going to be an increase in demand, the natural economic response suggests you're going to be investing to be riding into this cycle. To me it just defies economic logic, and maybe you can explain that to me.
Well, I'm a failed economist, so I won't pretend I have the answer to the question. But I think the first thing to say that we have to understand. I'm very convinced that most businesses, most companies, and most large and smaller companies, but certainly you're talking about the mining sector, are extremely well intended, are very purposeful, and have all stakeholders at heart. It's shareholders, it's employees, it's communities. I think that's very, very clear. Leave it from the inside, I think it's very, very clear. And there's no other choice if you want to be cynical, because that's part of reputation, and that's part of good business practices, and that at the end of the day, that creates value. Can they do better? Of course. The mining sector, as other sectors, have gone through phases, and I think everyone needs to find better ways of having a net positive impact. That's the first point. The second point, I think capital allocation framework, as it's being embedded much better now by the large mining companies, is no different than the capital allocation framework that I would expect the best companies to apply. In other words, you have to reinvest in your business when it comes to maintenance in particular, and we have to think that very large companies in mining or industrial companies or manufacturing have very, very large capital base that need maintenance, need sustaining. So first and foremost, you invest in a business to maintain your assets, to maintain the integrity of the assets, the quality and the efficiency. So that's where the bulk of the free cash flow is reinvested. And clearly, they have to pay a dividend. I think that's what the shareholders are expecting, and one would want to differentiate the shareholder behavior in the UK than in Australia, than in the US. And I think it's important to differentiate, in particular because some markets, and that's certainly the case of London Stock Exchange, are dividend markets rather than growth markets. So there's more of an incentive towards dividends than there is to growth, and you'll see it in applying different corporate finance model in the valuation of the company and in the share price, in a sense. And then, of course, there are you need to think in an iterative way of what creates most value. Is it to repay debt? Is it to do share buybacks, or is it to reinvest in the business? And there you take a very simple. Well, it's not simple actually, but in finance terms, it's actually simple. It's what's the best rate of return, and it makes economic sense to that extent. So why isn't more invested in growth? I think that's the right question. Well, number one, again, history of what has happened over the last 10 years, certainly, where the super boom was, the super cycle had a massive hangover and significant write-downs of a number of assets and investments. So imposed capital discipline, certainly by the shareholders. That's number one. Number two, Australia and the UK are mostly dividend markets rather than growth markets. That's what shareholders value the most. And I think there's very much a discussion to be had around the structure of these markets, around the purpose of pension funds, around the investment policies, and also about what the policymakers can do to promote more growth through different mechanisms. And third, incentive prices. So what is it that's not happening? Why isn't copper at twice the price it is today? Why isn't aluminum at twice the price it is today? And to a large extent, that's driven by short to medium term considerations. No, China is not expanding as it used to. We are not talking about 8% growth per annum, or even 5%. We are talking about deflationary China now, which is impacting in the first instance investment decisions where we are today. So the final point is probably because we have not seen the crux of the bottlenecks and the worst of the bottlenecks, I suppose, as of yet. But in my mind, no, mining is the new oil and gas in the next few years. In other words, for good or for bad, there will be much more focus on the mining industries in the next few years. But it's not yet reflected on enough investments.
Yeah. If you're saying it's the structure of the market, the structure of essentially the owners, being the shareholders of the business, that are causing a short-termist view, it's if the miners are taking the view that the energy transition is real and it's a necessity and it will be driven by global policy, it's a pretty inevitable conclusion that you'll need them to be producing a lot more. And the lead time for these to get these production assets online is long. Could it even be as cynical as saying, well, no, we'll wait until prices spike and then we'll invest? But it just seems like you won't be in a position unless you're focused on making your existing asset base more valuable rather than trying to lean into future markets. But that would suggest some sort of like oligopolistic kind of conversations going on amongst the majors, which is in a very competitive market. It's hard to imagine.
No, I don't think that's happening. That's not happening. I think large companies and mining companies again are we're talking about very, very purposeful companies, very well intended. I mean, they take economic decisions. Mining is risky. It's very, very risky. You talk about some projects that have a capex requirements in excess of $10 billion. Some iron ore projects in West Africa have capex requirements of $25 billion potentially. And often these projects are delayed, and it costs a lot of money. So these are significantly big investments, among the largest in the world, and risky. So the key reason why we're not going faster is because the risk is high and the incentive prices are not higher. There are other reasons, as I mentioned, and the structure of the markets, in particular London Stock Exchange, I think, is interesting to that effect. So I don't think there is any game being played by the businesses. No, quite the contrary. I think there's very well intention.
And do you see that the whole kind of ESG sustainability framework that are like this perfectly understandably being placed upon miners is slowing things down? Because I think that there's an inherent conflict there between we need to have stuff taken out of the ground as quickly as possible, but we also need to have it done in a way that is conscious and sustainable, and which takes lots of time and consideration and inevitably some more costs.
Well, definitely. You take a project like Resolution Copper in Arizona in the States, who has gone through an approval process for the last, I think, 2 decades, if I'm not mistaken, and that delays things clearly, and lots of money is being invested in the meantime. Engagement with communities is very, very important. Of course, again, mining companies are being hosted by communities and countries, so they have to respect that and make sure that they have a net positive impact, as they're trying very, very hard to have, not only during the development of a project, but also during the operations of a project, which of course lasts for decades, but then also thinking about after the project, when a specific mine site, underground, overground, or processing plant will actually be decommissioned. And they do all of that, but we're talking about planning over decades. So it by definition takes a long time. ESG, I think, is adding to the accountability, I think, and everyone should be welcoming it. If there is one thing good out of ESG, which is necessary today, of course, it's the accountability framework that it provides. So I think no one is shying away from it. Can we go faster? Could we get quicker planning permissions? Can we get partners around the table and really look in the same direction for the same business outcomes, which are also all about sustainability? Yes, all of that needs to happen, and it's not happening well enough, I suppose.
Yeah. If it's not big tech, then it has to be governments, and
Exactly.
there's a lot of kind of geopolitical machinations in and around. And actually, be very interested to hear your viewpoint of it. The media does tend to lead on the idea that China controls the mineral supply chain for the energy transition. Could you how true is that? Is there a grain of truth? Is it bang on? Is it somewhere in between?
China has been moving at a very, very fast pace from a macroeconomic point of view and social point of view for the last 3 decades, really. So everyone knows that, but they've been also moving into energy transition for much earlier than anyone else at a much bigger pace. Now there are more wind farms in China than anyone else in the world combined, right? I think. And I think they have 10 years ago already, if not before, had a very deliberate strategy around the rare earth elements and around also the processing of critical metals, critical minerals. So I think that's the first thing to say. The second thing is they do have a relatively high control over the processing of critical minerals. I mean that's well known. They are at the same time very interdependent with the West. No, they need iron ore. They are the largest consumer of iron ore, the largest by far consumer and importer of critical metals, copper, bauxite, nickel, which then they process. But there's a strong interdependency. They consume agricultural products. They are a very large importer of agricultural products, and they are also leaning a lot into technology, and they have developed a battery technology that's probably the envy of the world to a large extent. One would question as to why we would not copy, and now why would not rather partner rather than reinventing the wheel. So I think, unfortunately, we are in a world where the geopolitical tensions have increased significantly, and we are getting more disconnecting and maybe not talking enough to each other, but we have lots to learn from China. I think they are really embracing the transition in an incredible way and investing a lot into it. So I think the interdependencies have to be recognized, and we need to find a way. And that's easy for me to say. I'm not a political leader, but to re-enter into a dialogue that makes sense for everyone. Because at the end of the day, it's either lose-lose or win-win, right? There won't be winners and losers on the other side of the climate change disaster.
Yeah, that's one thing we're all united on, at least in theory. Yeah, we're all under the same sky, breathing the same air.
Indeed, yes. Yeah.
Which kind of leads on to the next point, which is the internal sustainability of the processes. So when you are extracting, it is like there's no other way of saying it. Like mining is a dirty business. Like it's with the best will and the best intentions in the world, there is going to be biodiversity loss. There is going to be, unless you can absolutely decarbonize a mine, there's going to be emissions. A lot of mines are in remote areas using a lot of like diesel. Very, very difficult to decarbonize, we talked about deep sea mining, touched on before. Also understand the pressure on the other side that you do need to be getting these minerals out. Taking the onshore mining, do you think that there is the will, the capability of decarbonizing the processes sufficiently fast to offset from the damage that is done by extra mining, to get the materials that we need for the energy transition?
So I think there's nothing more mind opener to visit a mining operation of a large mining company, because you are absolutely amazed by the quality of the people, by how caring the people are, by how purposeful they are, and by the amount of effort supported by money that is being put in mitigating the impact of mining and creating a sustainable future for communities, as well as to rehabilitate a mine site once it reaches the end of its life. And you can see it in the balance sheet of the mining companies. If only you look at the provisions for rehabilitation, they are in the billions of dollars, at times in excess of $10 billion. So I think one cannot be underestimating the importance that mitigating the impact and trying to leave a net positive footprint that the mining companies have. I mean, they definitely, it's entrenched in the controls, entrenched in the culture, entrenched in processes, and also entrenched in the capital allocation framework. Can more be done? Absolutely. So I can't really comment on deep sea mining. I'm not enough an expert on it. No, it raises a bit of a concern to me. That's for sure. Now, the fact is that mining has a footprint, as oil and gas, as manufacturing, housing, and many other industries, probably a larger footprint. I mean, steel in itself, I think, is 6% of the world emissions, which is not mining, by the way, but it's more downstream. So the question is, how fast is the decarbonization happening across the value chain? Significant investments are being done to that effect. Have they come a bit too late? Potentially. Are they going fast enough? Probably not. But I think there's significant effort being done to that effect. I think there's no debate in my mind, and I'm talking about the top 10 mining companies, around the significant alignment between sustainability and strategy, sustainability and shareholder value, and long-term viability of the business based on sustainability and reducing the carbon footprint.
Yeah. No, it's a very difficult conversation because there's trade-offs across the board in it. One story that took an awful lot of headlines was the Jucan Gorge from Rio Tinto, and that's the particular incident, which wasn't that long ago. And caused one legislation change in Australia, which is great, but it's not before 4,000 years of human history was taken out by a wish to get some more iron ore out of the ground. And it's now obviously the fallback, the blowback on Rio Tinto was large. CEO resigned, various chairmen resigned, a few other people left. Have you seen kind of shifts in culture since then within Rio, within the industry, that might prevent something like that happening again? Because it did no one any favors. That it did the industry no favors, and it did the business no favors, did the people involved no favors, did the local community, did national heritage no favors. It was a disaster no matter what way you look at it.
Yeah, it was a disaster. It was a tragedy. I mean, it came a couple of years, I think, after the Samarco tailing dams disaster also in Brazil. So I was group treasurer at the time. So sitting in an office in London may seem quite far away from what happens in Western Australia. But clearly, I think everyone in the business was pretty affected, and I think there was genuine sense of tragedy inside the company from the board to the senior management, to everyone, because I think the company, and that would be the same for the other large mining companies, which I'm not trying to defend, by the way. I'm just talking about it from a factual basis. Really think they care and they try to do the best. Clearly, relationships with communities are absolutely paramount. Were they being handled in the best way? I think one can look at the reports that have been issued, not only by the Australian Parliament, but also by the company itself that issued the report, and by the local Aboriginal community also, to get a sense for what went wrong. There are thousands of heritage sites in Western Australia and all over Australia that need to be better taken care of. This particular incident was probably more prominent because how ancestrally it was and relatively large. Yes, I think, no, unfortunately, it affected everyone. I think as the company learned from it, I'm sure they would say yes, and I'm sure they would say they're trying hard every day to make sure it never happens again, and they will have improved the processes and the accountability model to that effect.
So if we as we move towards a conclusion, I kind of zoom out a little bit again. I think one of the main themes we've been talking about is this structural inability to be pricing risk. Yeah, and there's just the difficulties involved in there. And if we did price risk properly, we'd have different outcomes, and the whole market would frankly work a bit better. One of the kind of ways of thinking about risk that you like to advocate is the idea of resilience. Could you kind of give us your thesis on how kind of resilience can be used as a frame of thinking to be able to better understand and price risk?
Yes, so I think, pricing risk is very hard, right? I mean, I work in a bank, and a great bank for that, with great colleagues who try to always do a better job at identifying, assessing, measuring and pricing risk. But it's really hard. Some risks are easier to price than others. So that's the first thing to say. So as per whether we are pricing climate risk well, no, the answer is clearly not. What's the right way of doing it? We're trying to find ways, and we are developing some methodologies internally. And the debate may sound quite intellectual at times. It is, but it has very practical implications around where we should allocate our capital and how we price our products and solutions for clients. I think the topic of resilience is of a different nature, because by definition one would not be able to price resilience per se, but it comes from a different perspective. It comes from a perspective of uncertainty rather than risk. It comes from a perspective of rather medium and long term rather than shorter term. And it comes from a perspective that whatever happens, you'll still be standing in your feet, and the business will still have the right business model and still be liquid and solvent, and will be able to carry on. So it takes a bit of a different thinking, and a number of companies are trying to price it. And I must confess, I was trying with my team to do that in my previous company, and we were trying. Have we succeeded? Probably not. But there are tools that serve you well. I think number one is, of course, long-term viability statements that are now standard in the UK and other jurisdictions, in particular for publicly listed companies. And they can take the shape of purely a narrative around where you see your business model having resilience issues, I suppose, over 3 to 5 years time, but also can take a quantitative approach using stress tests and reverse stress tests, and also more tail scenarios. For example, what if a piece of infrastructure is flooded? What happens, and what does it do to your business model? So I think the other aspect to it is really trying to understand what can go wrong based on a number of plausible scenarios. We are in a context where we need to think about it, and we might not have been in that context 5 years ago, or 10 years ago for that matter. We are in that context because climate change is real, because the risk to physical infrastructure is real, because supply chain disruptions are happening, and also because actually, even in the context of higher inflation, which many people have not witnessed in their careers, you need to think about what it means for the business, which you can price only to some extent. So building resilience plans is very, very useful. Long-term viability statements is only one piece of it. That's kind of pitching at the board level and for shareholders. But building in new operations resilience plans is very, very useful. Not because the plan will be correct, but because it forces a business to really think in terms of what-if scenarios and prepare accordingly.
And you're a strong advocate for the power of policy and government leadership towards making kind of systemic changes. Is there a role that you can see for policy in encouraging resilience?
So resilience is medium to long term. A policy, we would like to see it medium to long term too. As these two converge, and as we see in some countries, hopefully more of a long-term thinking, more of a long-term planning, more of decisions, including capital decisions or incentive decisions being taken for the long term. I think in itself that prepares better businesses to thinking around the same resilience plans. I think that's culturally the way we plan, the way we think is very important to drive behaviors across the board. I think regulators have a role to play. As I mentioned, long-term viability statements are now a requirement for FTSE 100 companies, and I think 200 too, for publicly listed companies. And it talks to only the next 3 or 5 years, the resilience of the business model. But using the Byron report, which is one of the key reports that talks about long-term viability of businesses, as other leading thought leaders on the topic. I think we creating that conversation around what may go wrong over time, I think is quite important. Now, credible transition plans that I referred to earlier on, for me, are also part of the resilience thinking. Because credible transition plans, like any good plan, should not be set in stone for the next 5 years or 10 years. Without detriment to actions and to accountability, has to be adapting to what's happening in the world. And I think these conversations are not short-term conversations. At the minimum 2030, because we use this as a milestone. At the minimum, and by the way, it's only 6 years ahead, 6 years,
Yeah.
6 or 7 years in front of us. So I think these are the frameworks that we need to use to talk about resilience, and it goes often beyond the life of a loan. If I talk in terms of bankers, financing being only one of the tools we provide to our clients, of course, or the solutions. Beyond the life of a loan, which often doesn't go beyond 7 years, it can, but we need to think about what the business is doing to adapt.
An excellent way to finish it. But what we typically do is ask one last question, which is for a little bit of advice. If we're looking at the area of resilience, what would your top tip be for somebody listening to this, watching this, for having a resilient career?
Well, the best advices I can give are the ones I'm borrowing from many others, many great people I've met in my career in the different companies I've worked with for, and people I've worked with. Clearly, as the motto says, if we fail to prepare, we are preparing to fail, and that's very, very important always to prepare well, to have a plan, and to be able to be resilient around that plan, which is to adapt very, very quickly. I think pace is very important. At the end of the day, actions speak louder, and at individual level, as well as at business level, at government level, what talks the loudest is us delivering on actions, performing on the day-to-day basis. And it has to be on the back of a strong value system. So I think we are all the more resilient as we prepare for the future all the time, every day. That matters also at the family level, at the personal level, but also as we perform day in, day out. Action is the best theory. And it can only make sense if it's out of a purpose, out of a very strong value system, which of course has to be around respect, which has to be around embracing diversity, which has to be about trying to learn always from others, and it has to be about a culture of excellence. So I think that's the advice I am borrowing from many conversations and from what I've learned over the last many years.
There's a huge amount of wisdom in that. Thank you so much. Thank you so much.
Thank you, Chris.
Really, really great conversation.
Thank you for the conversation. It was great.
Well, thank you very much for joining us on that conversation. We hope that you enjoyed it. We hope that you learned something. If you did enjoy it, please feel free to leave a 5-star review and to subscribe to any of our channels, and we'll be sure to keep you updated on future productions. This series is produced by United Renewables in collaboration with the London Business School Alumni Energy Club.